been undertaking an educational intelligence campaign to speak more frequently about some of these looming liability issues. This presentation is going to go over what the implications are for the state of Hawaii. I want to talk about at the federal level, what the recent events in the federal congressional issues, what the implications are to Hawaii and to your and my Hawaii state government are. And if you look at the budget that we all passed for this current biennium, the pie chart on the left, pie chart on the right is FY12 and 13 respectively. This is the budget, $11 billion estimate for each year relative to sources of funding. Okay, and the big portion of the pie on the right is the general fund. And that's the area that the Council on Revenues really looks at. But this piece here that's also a significant piece, that's about a quarter of the entire pie, is federal funds, to the tune of about $2 billion each year. And in the years past, due to ARRA, stimulus funds, that piece of the pie was actually a little bit bigger. So the implications here is not so much the size as the title implicates, for the means of funding. It's really, what do we do when this is a picture of all federal funds by a sample of departments. And the big one is Department of Human Services receives about 1.3 billion, or is counting on 1.3 billion, I should say, in federal funds for this biennium. We have the Department of Education, which is counting on about 260 odd million in federal funding. And in total, for all of this and then some, it's about $2 billion each year for the biennium. The implications are the federal, Congress with its super committee, we are expecting that this picture here will not come to fruition. And we should prepare ourselves that likely these programs are not going to receive funding to the level that they think they're going to get. But what's even worse is if you look in the context of the last several years, this amount already is less than what departments have received last year and the year before. Because ARRA, the American Recovery Act funding, has expired. So we will not be receiving those funds to the level we have historically got them in the recent years, and for which we've established programs that have been in existence as recently as December 2010, and that have been slowly curtailed. We are talking about potentially either eliminating those programs, some of which we have only come into fruition over the last 5 years, but for all of them, which people have become somewhat dependent upon, or at least expecting that they're going to be there. This is a slide of the US Treasury yields going back to January 1st. This is the yield for US Treasuries, 1 year, 5 years, 10 years, 20, and then 30. And as you see, it's going down. Now, as an investor, this is not a good deal, right? Your 30 years, as on October 1st, a 30-year US Treasury bond was earning 2.76% yield. If you wanted to invest for 1 year, it was 0.12. That's not good for investors. For lenders, or for people who are seeking to get borrowed money, like the state of Hawaii or the US government, this is actually a pretty good, this is cheap cost of capital here. And the line that I marked here is the S&P downgrade of the US debt. It's right around August 5th. And prior going into that market, everybody thought that a downgrade would mean more cost of capital for the US and for local governments. And that's the typical textbook expectation, right? Lower credit ratings equal higher cost of debt. That's not what happened. We're seeing something going on here where the flight to safety, as you would call it, people still are recognizing that the US debt is the safe haven for funds out there, and could be the problems that we're experiencing in Europe, devaluation of currency across the planet. You're seeing people flow to buy US debt, and so it's cheap. And in terms of where Hawaii is, we expect that these rates means if we wanted to borrow money, this is an opportune time for the state to borrow funds. Let's look at that question. If we wanted to borrow funds, how much do we actually spend on debt service for any given year? This is a historical graph going back to the year 2000 through fiscal year 2011. This is the amount of debt service that was actually paid. The green bars here, or the light color bars at the bottom, represent principal that was paid, and the darker colored bars is interest. Now, what is interesting to note is the flow of this trend line is not consistent, right? You see these dips here, where for some reason in 2004 and 2005, we actually paid less debt service than the years prior, but then it peaks in 2006 through 2008, and then kind of wanes off in 9 through 11. That is actually a factor of some restructuring and refunding of debt that the state had to employ in those years to immediately get savings in those fiscal years. This was a fiscal measure, but for those restructurings, you would likely see the debt continue to rise, this gap would be filled, and this over here would continue to move up. So all of the space below where the trend line should be is basically fiscal savings that the state had to realize in those fiscal years in order to make it through those years because of either revenue projection shortfalls or deficit identification. So now when we go forward in terms of where we are going to be in the next several years, the projected debt service through 2030 on the current outstanding general obligation bonds. Now, for the current fiscal year, we are projected to have we have a debt service of $527 million this current fiscal year. It will go up to $596 million in 13 and 14, peak at $626 million in 2015, and then slowly start a decline over the next couple of years until it tapers off going out. Now, what I'll point out here is that this slide represents only currently outstanding GO bonds. The state of Hawaii has not sold any GO bond debt since December, January of 2010. So it's been over a year and a half since the state has gone and sought new debt. So this profile has been in existence, for that entire time, a year and a half, basically. The nature of Hawaii government, the nature of governments by and large, is we cannot go a long time without assuming or selling new debt. The state of Hawaii only sells debt to fund capital projects. And so when we run for a year and a half in excess without new monies to replenish the capital improvement projects fund, that can be problematic. It will run out at some point in time. So we have to sell new debt. According to the proposed financial plan and budget, looking out through 2015, this is the schedule of new debt. For 2012, it's plugged in for 2 issues of $375 million apiece in the first half and second half of 2012. And the same for 2013. In 2014, $350 million in 2 issues for 2014, and then in 2015, a $350 million issue, followed by a $325 million issue in the second half. Now, this doesn't mean that this is the schedule that is going to be employed. This is just the projection for the benefit of the financial plan that the legislature contemplated with its budget. But if we were to hit on this schedule, what you would see is In 2012, another $9.8 million in debt service in the current fiscal year. In 2013, another $49.2 million. 2014, another $87.9 million. And in 2015, another $124.7 million on this schedule, okay? We likely will modify or migrate away from this schedule just because, one, interest rates, but two, the current state of the bond or CIP fund. Also, other factors that affect the rates are the actual capital expenditures during these time periods between the times that we sell debt. So there are a number of factors. Again, if we look back in terms of where the credit markets currently are, in my opinion, it's a good time to be in the marketplace if you wanted to or needed to assume debt. This is a table for as of July 1st, 2010. What is the current amount of outstanding debt throughout the entire state for all forms of bonds? So general obligation bonds as of July 1st, 2010 was at $5,126,000,000. This amount as of today is actually less because a number of durations have retired or those bonds have matured. And if you remember, we haven't sold any debt since January 2010. HHFDC has outstanding bonds for about $440 million. HHSC has outstanding bonds of about $11 million. Hawaiian Homelands has outstanding bonds of about $41.8 or $9 million. And the University of Hawaii has outstanding bonds of about $351.6 million. Those are all revenue bonds, equating to about $2.44 billion in revenue bonds outstanding. So between revenue bonds and GO bonds, the total outstanding debt for the state of Hawaii in terms of long-term issued debt is $7.56 billion. Now, in May and June, the state of Hawaii was downgraded on its credit rating, just like the U.S., downgraded by Moody's and Fitch. Of course, it's bad to get a downgrade. No finance director wants to get a downgrade on their watch, but I think what's more important is the reasons for the downgrade. And Moody's, in downgrading the state's bonds from AA1 to AA2, they cited 5 significant points. First, they cited the overall financial strain and economic recession over the last several years have actually, of course, have diminished the revenue capacity for the state, and they recognize that trend has been very prolonged and not showing too much signs of overall improvement looking forward. But they did recognize some stabilization in the revenues at that current level. They also cited the depletion of reserves. There's only 2 reserves in the state of Hawaii, the Hurricane Relief Fund and the Emergency Budgetary Relief Fund, or the, quote, Rainy Day Fund. Since 2010, the states accessed both of those funds a number of times, and we all recall that in order to close out fiscal year 11, we needed to access and utilize both of those funds to fill a revenue shortfall for fiscal year 11, to the point where we've essentially depleted both of those reserves to less than $10 million in each of them. The last 3 points here are the ones that I really want to emphasize. They also cited that our pension-funded ratios are low relative to other states and are projected to decline. So this is in the ERS. The demographics on the ERS is that the last actuarial report, which is through June 30th, 2010, sets the unfunded liability at about $7 billion. The funding duration is in excess of 40.2 years, and its funding status is about 60%. And that puts us relative to other states actually in the bottom half, near the bottom third of states in those ratios. The downgrade also cited high debt ratios. Hawaii has one of the highest per capita debt ratios of any state in the country. In fact, it's probably in the top 5. I'll caveat this though. One of the criteria for the debt ratio is they look at the overall outstanding debt relative to your population base. For the state of Hawaii, because the primary education system and the public safety system, capital projects are funded at the state level, it doesn't provide clear metrics to compare with other states, because other states' public safety and or education are not funded up at the state level, or at least not for the majority of states. They're funded up at lower either county or municipal levels. So that's one metric that Hawaii, it's not enough to just compare on that debt ratio. But the credit agencies have cited that. And the last is the OPEB, or other post-employment benefits, parentheses, other than pension, so that in Hawaii that's our health fund for retirees. Our obligation is identified as sizable and growing. The EUTF, which funds retirees, that obligation on unfunded status is about $14 billion. Zero corpus. We've identified that the state pays on a pay-as-you-go for retirees. We have not demonstrated any proactive method to fund the ARC on a pre-funding basis. Thus far, the state of Hawaii has not demonstrated that we have any intention to do so. So this is one area where the agency has identified that we are not proactive enough. Fitch cited the same point as Moody's did in downgrading the state from a AA+ to a AA. Both of those downgrades, though, had some glimmer of hope that those agencies previously had Hawaii with a negative outlook. They upgraded us on the outlook side to stable. For the ERS on the pension side, we're seeing the overall valuation of the corpus, if you will, or the funds that are under investment have declined. This is a factor of market conditions. The equity markets have not performed as well. As we all know, there's a statutory assumed rate of market performance in HRS. It's 8%. The equity markets have not done that well for quite some time. There was some glimmer of hope in 2010 where the equity markets, at least the investments, under investments in the ERS, did outperform the 8%. But the ERS also blends its gains and losses across 4 years. So even though you may have a positive gain in 1 year, it's going to be blended with the other 3 years where you had negative gains. So the overall rate of return is not as good as it was actually realized in 2010. Funded ratio did decrease. And this third point here, the funding duration jumped from 28.2 years in 2009 to 41.3 years in 2010. This, again, Hawaii Revised Statutes has a requirement that once the funding duration exceeds 40 years, the legislature is compelled to consider changing the funding mechanisms or the calculations, of which it did in Act 163 in the last legislative session to make some changes to employees not yet hired. Employees hired on June 1st, 2012 to reduce their benefits in the ERS, increase the contributions that the employers put in for those employees. All of these, I will tell you, will not do anything to the unfunded liability as it currently stands, okay? Because these are for employees, one, these are for employees not yet hired. Two, it will only apply to those employees once they are hired. So the current liability, which is on employees that are currently hired and retirees or soon to be retirees under the system, their benefits, their actuarial calculation is unchanged. So this measure does nothing for the reducing the unfunded liability. The legislature also reaffirmed or continued its moratorium on any enhancements to the ERS benefit until the funded ratio reached a certain level. It previously was 80%. The legislature has changed that to 100%. That's a good measure. On the last slide, in terms of the OPEB, the other post-employment benefits, this picture is far more dire. The ERS, while significant, I think there's some positives there. The legislature did make some improvements. We call that the pension reform. It is for new employees, but it's at least some modest measure to demonstrate proactive. It also has a significant corpus. Arguably, it's only 60%, but if the equity markets assist, there's something to build on there. On the OPEB side, for the EUTF, there's no corpus. We have no funding mechanism. We have benefits that are not defined as they are under the pension system. You have retirees that have a far more expensive benefit when they retire than when they're working. So that combination just projects a further escalation in the unfunded liability for ETF. The last OPEB report as of July 1st, 2009 set the accrued liability at about 14 billion. The state has always been on a pay-go method, meaning that we don't account for or pay for future liabilities in the budget. Whatever the monthly bill is for retiree premiums that month, that's all we pay. In the past, the state has demonstrated its intent to try and control the growing cost in health benefits. For instance, prior to 1996, employees with 10 years of service used to get 100% of their medical and retirement paid for if they have 10 years of service for them and for their spouse. Change after 1996 limits it to it so it's tiered right now. You only get 50% of your benefits paid after 10 years, 75 after 15, and then 100% of your benefit is paid after 25 years, but only for that employee, not for their significant other or spouse. That's a significant change. We're starting to see some of that bleed through in terms of how the unfunded liability is calculated, but it takes a long time because even at that measure, it was for future not yet hired employees. I would tell you that as far as the administration goes, you folks are aware that we tried to make some proposals that would get towards actively addressing unfunded liabilities. This is an issue that I think as more and more people become aware of, everybody has a very significant opinion on. Primarily, you are talking about benefits, so support to reducing benefits is not strong there, especially for employees. You have a very large constituency here about trying to change on the benefit side. But as you can see, there are very large costs that are only projected to grow. We haven't done anything to actively deal with these costs on a fiscal year-to-year basis. So we have to start looking at what do we have to do for the future, because there are implications, serious implications and ramifications for all taxpayers, whether you are a government employee or have government employee relatives or friends or family. Every single taxpayer will be impacted. They cannot be impacted when you're talking about $21 billion in unfunded liability on the pension and the EUTF. And the earlier question about from Representative Fontaine, what happens if there's a run on the ERS system, people immediately pulling out their funds? Well, one, the ERS is only 60% funded as of the 2010 numbers. If everybody who was entitled to a benefit today sought that benefit, 40% of those people would not get paid, or 100% of the people would only get 60% of their benefit. But the implications are for the taxpayers is that the ERS pension is constitutionally provided for. So if there was a run, every single taxpayer will have to pay to ensure that benefits are 100%. That's the implication. If you look at the EUTF side, 100% of the benefits are not covered. Okay, there is no corpus. It's arguable whether or not constitutionally those benefits are provided for. But if there was a run, as you will, on the EUTF side, you're talking about significant coverages that would have to be met up in the by taxpayers on a fiscal year basis. So both of those contributions, I'll just give you the quick numbers on it. The ERS, employers contribute about $660 million, or at least for the last several years, they contribute about $660 million a year. Employees contribute another $280 to $300 million a year. So if you do the math, it comes out to $1 billion. The last 2 years, the ERS has paid out $1.1 to $1.2 billion in benefits each year. That means there's a negative $200 million cash.
Thank you, Mr. Young.